$3,847 in voluntary tips. For money he had already earned. March 11, 2026, 6:47 a.m., Toledo, Ohio. Travis opened his phone on the warehouse floor. Every app locked. Negative $17 in checking. Every cent of Friday's paycheck gone before his alarm. He hadn't bought anything. He hadn't borrowed from anyone. The money had just vanished, and Travis couldn't explain why. 11 months earlier, Travis was the kind of guy who packed his lunch the night before to save $6 at the vending machine. 24. Toledo, Ohio. Order picker at All Points Fulfillment. $17.40 an hour. He downloaded EarnIn on a Tuesday in May 2025. The app promised something simple. Get paid for the hours you have already worked. No credit check, no interest, no fees. Just, if you wanted, a tip. His transmission had started slipping that week. The mechanic quoted $280. His checking balance was $94. Payday was 4 days out. He opened the app. The screen said $100 available. He tapped the button. The money landed in 19 seconds. Then the app asked him to pick a tip. 9 options. $0 to $14. He chose 4. It felt like rounding up a bartender. If you could get $100 right now for money you had already earned, for what felt like rounding up a tip, would you tap it? The gap was already there. He just hadn't seen it yet. The next Friday, his paycheck was $697. After the cash advance and the tip came out, it was $593. He didn't notice. By June, he was taking 2 advances per cycle, one on Thursday for gas, one on Monday for groceries. Tips climbed. 4, then 5, then 7. He told himself tips were pocket change. In July, he added Dave, then Bridget. The Dave advance was $200. The Bridget advance was $250. Each app asked for its own tip. Each one pulled from his paycheck a week later. By August, the math stopped working. His paycheck hit checking at 11 p.m. on a Thursday. 4 different apps pulled money out before his alarm went off Friday morning. Kayla noticed first, his girlfriend of 2 years. She didn't live with him, but she saw his card decline at a diner in September, twice on the same visit. He laughed it off, said his bank was glitching. I thought a tip wasn't really interest. I paid my rent. I paid my phone. I never missed a payment. I just kept getting less every Friday. On October 29, 2025, the timing belt in the car broke. $480 at the shop, not counting the tow. He had $11 in checking. 3 cash advance apps were already maxed out. He sat in the break room and did the math for the first time. Not the advances, the tips. He opened EarnIn, tapped his history, scrolled. $3, 4, 5, 7, 6, 4 again. He counted 112 tips in 5 months. Average $4.40. $492 on EarnIn alone. Not counting Dave. Not counting Bridget. Not counting MoneyLion, which he'd added in September. He'd never signed a loan document. He'd never seen an APR number. But the money was gone, and the paycheck coming next Friday already belonged to the apps. Here's what he didn't know. A Harvard economist named David Laibson had mapped the exact brain pattern Travis was running. 1997, Quarterly Journal of Economics. Laibson called it hyperbolic discounting, the quirk that makes $100 today feel worth more than $150 next Friday. Not a little more, a lot more. That's the wiring the tip screen exploited. The $100 was real. Right now, the $4 was 9 days away. Travis's brain saw those as 2 different universes. The California Department of Financial Protection published a study in 2021 on earned wage access apps. When tips and expedite fees are calculated the way the CFPB calculates APR, the average effective rate was 334%, higher than most payday loans the state had outlawed. Travis had never seen the number 334. Nobody had told him one. By mid-November, he decided to consolidate. He'd read a Reddit thread about using a personal loan to pay off cash advance apps. Clean slate, 1 payment, lower rate. He applied at One Main Financial on November 16th. Approved for $3,000 at 29.99% APR over 36 months. Monthly payment, $127. He paid off every app on the same Sunday afternoon. Uninstalled EarnIn, uninstalled Dave, uninstalled Bridget, uninstalled MoneyLion. For 11 days, he felt like he'd escaped. Then his landlord raised the rent on December 1st, $480 to $780. Overnight. His paycheck couldn't cover it. He didn't put the apps back on his phone that week. He did it on a Thursday at 11:14 p.m. while Kayla was asleep on the couch. He told himself it was different this time. He still had the personal loan paid down. He was just bridging a gap. By Christmas, he'd reinstalled all 4 apps. He was paying the one main loan and the new tips. The consolidation hadn't reduced his debt. It had added $127 a month on top of everything else. By January 2026, the apps were pulling on top of each other. EarnIn Thursday, Dave Friday, Bridget Saturday, MoneyLion Monday. Rotating, stacking, every tip eating into the next advance. He ran out of Paycheck on a Wednesday for the first time. Wednesday, not the weekend. His direct deposit was due in 9 days. You ever tell yourself this time will be different at 11 p.m. on a Thursday? Kayla asked him plainly in his kitchen on a Sunday. Travis, how much do you owe? He looked at her and said, I don't know. It was the first honest thing he'd said in months. He told his mother 2 weeks later. She drove up from Cincinnati. She sat at his table and wrote down every app, every advance, every tip. The paper ran to both sides. A 2024 report by the Financial Health Network found that the average earned wage access user takes 36 advances a year. That's roughly 3 per month. Travis was taking 14. At one point in February, he was on a rotation with all 4 apps at once. His mother, looking up from the paper, You bought these apps a cup of coffee. Every single day. For almost a year. She counted. Not the advances. The tips. The paper had hundreds of entries. She didn't say the number out loud. She just slid the paper across the table and let him read it. She asked him one more thing. Why he never called her. He said he didn't want her to know he was the kind of son who tipped for his own paycheck. 4 apps. 14 advances per month. Every paycheck partially eaten before it arrived. On March 9, 2026, EarnIn rejected his advance for the first time. Account restricted. Dave, Bridget, MoneyLion. Every door closed on the same Tuesday. He had $4 left. Rent was due in 6 days. Here's the part almost nobody explains. None of what Travis did was legally a loan. That was the point. For years, earned wage access apps argued they weren't lenders. No interest, no fees, just a service. Tips were voluntary. Technically, the CFPB disagreed. In July 2024, the agency published an interpretive rule. They said plainly, when a worker pays a fee or a tip to access wages they've already earned, that's a credit transaction. That means the Truth in Lending Act applies. That means APR disclosure is mandatory. Section 1638 of federal law. The cash advance companies pushed back. They argued the tip was a gift. They argued workers could opt out. Across state regulators and federal courts, the same question kept coming up. Was this really not a loan? Travis had been tipping EarnIn for 11 months by the time that question reached a courtroom. On every single advance, every tap, every 9-option tip screen. He'd never seen the word APR once, not in any email, not in any notification, not in the fine print of the terms of service he'd agreed to at 11 p.m. on his first Tuesday. The apps never told him because under the loophole they were using, for 11 months they legally didn't have to. If a product behaves like a payday loan, charges like a payday loan, and traps people like a payday loan, why does the word tip make you think it isn't one? If this changes how you see cash advance apps, subscribe. Next week, we're inside a different one, and that one is worse. He sat down with his mother and wrote a plan on the back of the paper that had the tips on the front. Then he did 3 things. First, he deleted every app and blocked the bank authorizations from inside his bank, not theirs. Second, he moved back in with his mother for 90 days. Cincinnati, no rent. Every dollar went at the one main loan, highest fixed rate, hardest to escape. Third, he went cash only. He bought small envelopes at the dollar store. Groceries, gas, and coffee each got their own. He's not debt-free. It'll take him 11 more months to clear the one main loan. 4 years, by his estimate, to rebuild his credit from the low 600s. But no app has touched his paycheck in 6 weeks. Here's what this story teaches us. 2 things, and neither of them is what the apps want you to know. First, the word tip isn't a legal category on your paycheck. It's a workaround. Earned wage access companies built their entire product around one legal loophole. If a payment is voluntary, the Truth in Lending Act doesn't require them to quote you an APR. That's how a company can charge you the equivalent of a payday loan while the screen says, no fees, no interest. The CFPB moved against that loophole in July 2024 with its interpretive rule. If you're using a cash advance app right now, you have a federal right to ask for the effective APR in writing. Send one email to their support address. Cite Section 1638 of the Truth in Lending Act. Ask for the all-in APR, including tips and expedite fees. What you get back will tell you everything. When regulators ran the math in California, the average was 334%. Second, hyperbolic discounting, Laibson's paper, isn't a character flaw. It's a brain feature. Your brain was built to value today more than next week. Cash advance apps don't fix that. They monetize it. The defense isn't willpower, it's friction. If you have the apps on your phone right now, move them off your home screen tonight. Then, tomorrow, revoke their bank access inside your banking app, not theirs. Not the disable button in the cash advance app. The bank-side authorization control. That takes 9 days for them to reverse. 9 days is how long your brain needs to remember why you closed them. The cash advance industry has grown from a niche service into one of the fastest-growing corners of consumer credit in America. More users, more apps, more tips. The Financial Health Network found that the typical user is a full-time employee, making between $35,000 and $60,000 a year, who has never taken a payday loan in their life. That's the part that changed my mind on this. The trap isn't for people who made bad choices. The trap is for people who never thought they were borrowing. I've been covering these stories for a while. This is the first one where the trap was actually invisible. Travis never signed a loan document. The word interest never appeared on any screen. That's the design. Do one thing tonight. Open your banking app, not the cash advance app, your bank. Look at your recurring transactions for the last 90 days. See how many pulls come from EarnIn, Dave, Bridget, MoneyLion, or any other cash advance app. Add them up. Tell me the number in the comments. I read every one. Subscribe. Travis still works at All Points Fulfillment. Same shift, same wage. He still has the car. But on Friday mornings, his phone doesn't buzz at 6:47 a.m. anymore. His paycheck shows up at 11 p.m. on Thursday. And it stays there.